Hello, today is Wednesday, March 3rd, 2021, and thank you for joining me for another edition of the Market Commentator Podcast. My name is Andy Wilms, and I am the President and CEO of the Milwaukee Company. Joining me this morning is Maureen O'Leary, President of O'Leary Group Law Office SC, which was previously Wilms O'Leary SC, Maureen being my former law partner. Good to talk to you today, Maureen.
Good to talk to you too, Andy.
Maureen and I today will be discussing how potential changes to gift and estate tax laws could affect your investments. And this is an area of law I practiced for a little over 30 years. And Maureen and I've worked together for, 13 years, Maureen, I think it is.
That's about right.
But before we get started, I need to remind our audience to please keep in mind that this podcast is for informational purposes only, and listeners should conduct their own independent research before acting on any information or opinions expressed this morning. The views expressed in today's podcast are Maureen and my personal views and not those of the Milwaukee Company or O'Leary Group Law Office SC. And with that, Maureen, I'd like to talk to you today about the estate and gift tax laws. And there's a lot of changes going on in this regard, or in this part of the Internal Revenue Code. And some of those changes could have a big impact on our listeners and other investors. So let's start off with a quick summary of these transfer tax provisions. We collectively refer to gift and estate taxes as transfer taxes. And why do these laws matter to investors, and what's the current state of these laws?
Well, Andy, gift and estate tax laws, which, like you say, you can wrap that up as transfer tax laws, they matter to investors because a really big gift tax bill or a big estate tax bill can take a very significant bite out of any investor's portfolio. For high net worth, or go ahead.
I just said it could wipe out years of gains that you've made in the market.
Absolutely. And it can be preventable in many circumstances. For high net worth families, transfer taxes can be the biggest expense of their lifetime. But if they do planning, there are things that can be done to help minimize and sometimes completely avoid gift and estate taxes. So, for example, at the moment, gift and estate taxes tend to only impact wealthy investors. So I'll give you a brief overview of where we are now, and then we can talk about where we might be going. Most people, of course, they know about the annual exclusion, where you can give everybody up to $15,000 a year, as many people as you want. But in addition to that annual exclusion, there is a lifetime exemption amount. And this is the amount that a person can give away during life or at death. If they don't use it during life, the balance can be used at death. And that exemption amount right now is at a historic high. It is $11.7 million per person. So that means a married couple can transfer almost $24 million tax-free during their life and at death. So,
Maureen, does this mean everybody who's listening that doesn't have $24 million should turn off the podcast now?
No, that would be a mistake. That'd be a big mistake, because there is these high numbers are not expected to last forever. In fact, they could be changing pretty soon. So definitely stay tuned, everybody, because we're going to tell you some more information that you need. And of course, the problem is that anything on top of that exemption amount, above and beyond, for very high net worth families, is subject to an estate or a gift tax. And right now, that's a 40% rate of the excess. And so here's what everyone needs to know. Under current law, the exemption is scheduled to cut in about half, down to about $5 to $6 million per person. And currently that's scheduled to drop in 2026.
So that happens if nothing else changes. The amount, anybody within the state over, let's say, $5 million or so, is looking at a 40% estate tax bill when they die, all things being equal.
That's right. Exactly. So, but of course, these were the laws that were put in place during the Trump administration, and, politics have changed a bit here. So things could change again in these tax laws.
Right. And I know there's been some, Democrats have suggested, and I'm not picking on the Democrats, it's just that it tends to be the Democrats seem to be the ones most interested in seeing estate tax laws reformed so that more people end up paying it. And I think one of the things that they've been tossing around is well, two things really. First is that we should maybe make this exemption not wait till 2026 to cut it back. We should cut it back sooner. And secondly, maybe we should cut it back further. Can you offer some insights on those two ideas?
Yeah, absolutely. So President Biden's tax plan calls for returning the estate and gift tax laws to 2009 levels. So we don't know exactly what this new tax law might include, but it suggests an estate tax exemption amount of $3.5 million per person, and only a $1 million gift tax exemption. So you could only use $1 million of the 3.5 exemption during life, and then the remaining 2.5 could be used at death. And a return to 2009 levels also means an increase in that gift or estate tax rate from 40% up to 45%. So that basically means anything that someone would give during life above $1 million per person would be subject to a 45% gift tax. And at death, if your total estate, including gifts during life, exceeded $3.5 million per person, again, you'd be looking at a 45% estate tax if that were to happen, which is definitely a concern to a lot more people than current levels. But then again, Biden's plan could just be an opening bid, and a lot of commentators think that his bid is setting up negotiations for where they'll ultimately land after negotiations in the House and Senate. So a $5 million exemption amount is not, that might be an even more realistic guess, but it's really anyone's guess right now as far as how low it would drop.
You're talking about what the amount would be, and one of the things I find interesting is that that we're all used to the amount you can give away during life and the amount you give away at death being unified. Right. That's the way it's been for a long time. But they're trying. The Democrats are Biden's proposal, I should say, would keep the death, lower the gift tax exemption all the way down to $1 million, and so now you would no longer have a unified system, and there's some logic to that from their perspective, right? Because you want the gift tax exemption to be as low as possible because you want to discourage people from giving away assets during life, because for two reasons. First of all, because if you give the asset away, if you can't give the asset away during life and it appreciates in value, all that appreciation is subject to estate tax too. Mm-hmm. And second of all, by putting the exemption low, a gift tax exemption low, you create the opportunity to further reduce the estate tax exemption while someone is alive. One of the things that you and I worked on together is getting people, right now, the gift tax and estate tax exemption are very high. And because the gift tax exemption is also high, not just the estate tax exemption, it makes a lot of sense to use it before you lose it. And we can talk more about that as we go on. But you were about to get into the when part of it, and that's a big
absolutely.
issue.
But thank you for just laying that out, because that's really the big takeaway from this podcast, is that currently you can give away up to $11.7 million per person. And it's possible that if the exemption were to drop to $1 million, you'd only be able to give away $1 million. So right now you can definitely use it. And we don't know when we're going to lose it. So maybe we focus on that for a bit here. The when is perhaps a bigger question than even the amount for some people, because it's such a big unknown. Technically, tax legislation could pass this year, and if they wanted to, it could take effect retroactively to January 1st of 2021. But many commentators think that's unlikely to happen. The general consensus seems to be that an effective date would probably be January 1st, 2022 at the earliest, or perhaps even later. And a big reason for this is President Biden has messaged that his top priorities are the pandemic, racial equality, climate change, and the economy. So he has a lot of other projects that he's working on right now, and changes to the tax code may be coming soon enough, but he has a lot of other competing priorities for the administration. So we just haven't seen much movement yet on the tax code changes yet.
Well, I agree. But we had a lot of our common clients used their exemptions last year for
Yeah.
fear that if the Democrats won, that they would be looking at this potential for a retroactive change. And I tend to agree it's unlikely, but the cost is huge, right? I mean, you buy insurance, even though it's not likely your house is going to burn down. Well, this is far more likely than your house burning down, and the cost would be much greater than many people would lose if their house burned down. But the fact of the matter is that ship has sailed, right? You can't go back and make a gift now that wasn't done in the past. But it does make a lot of sense to me to consider ways of using the exemption this year in hopes that it isn't taken away retroactively. And there, in that regard, there's a couple of arrows in your quiver, Maureen, on how you can do that. You can give them a chance to undo if they make the gift and the law doesn't change. You can undo. There's ways you can kind of undo the gift, for lack of a better word, and not without being an Indian giver. and there's also the other concern that people sometimes say is, well, if I take advantage of the exemption and give away a big hunk of my assets, I'm going to lose the income that I need from those assets to live on. And there are a lot of ways we can, or you can now, to do that where people still get the benefit of the income from the property that they've given away to take advantage of the high exemptions currently, right?
That's right. There's a lot of different ways you can structure gifting, but it is trickier gifting now in 2021 than it was at the end of 2020, because now that it's 2021, anyone considering a large gift needs to consider whether they're willing to take the risk, however small it may be, that there could be a retroactive gift tax exemption drop. And if you're worried about that, then we've got to make sure we structure that gift in a very intentional way.
Right.
And of course, there's also, before we even get it too deep into some of the planning ideas, I want to mention that there's also a constitutionality question here of whether a retroactive gift tax exemption drop would be constitutional. And the general consensus there is that it would be, and it's possible, but practically there's just a lot of reasons it's probably unlikely to happen. And part of that is just the narrow margin that the Democrats have in the Senate right now, because in order for tax legislation to pass, they're going to need all 50 votes, which includes the 2 independent senators who caucus with the Democrats, plus Vice President Kamala Harris casting the tie-breaking vote. And all that is just for a simple majority. So they can't afford to lose a single vote. And, what I've heard from just the industry is that a lot of the more conservative Democrats would be opposed to a retroactive change. And if even there was one holdout, having the conflict of this retroactive date be part of the package would probably just stall it. So that's why we're thinking that a future date would be more likely than a retroactive date.
Well, I think that's clearly the case, but I do think that the possibility of this being retroactive is significant enough.
It is
that you need to, when you make your gifts, you make sure that you can undo them. If you don't want to, if you're concerned about the possibility of having to pay a gift tax on the gift, we could go on for a whole podcast of why paying gift taxes during life can actually be an advantage, right? Save total taxes.
Absolutely.
But to avoid getting in too far into the weeds, let's assume that most people would like to have at least the flexibility to say, what, now that they changed the law, I want to undo this gift. And it's not as unlikely as some people might think, because I'm not all sure you couldn't get a couple of Republicans to vote for it.
Mm-hmm.
There's some left-leaning Republicans, as we know. And so, what would you like if you have a client says, okay, I'm going to make a gift this year, but I don't want to be locked in case the law changes? How would you go about that?
All right, so there's a few ways to do it. One way is to get the planning in place, get everything teed up. Let's assume you're making this gift to a trust or multiple trusts. You could have the trust drafted, the accounts opened, and then you have a couple options at that point. You could wait to make the gift until later in the year, but at least all of the lawyering is done, everything's in place, so it's just a matter of transferring the money once there's clarity later in the year. Another approach is to make a loan to a gift trust like we described, because then at the end of the year, you could forgive the loan, which would be a gift at the time you do that. So again, that's again almost another wait and see approach. But the key with both of these ideas is that the work is done now, because this can be a lengthy process, take some time, and sometimes once tax legislation gets in the pipeline, there's not enough time to do all this gifting then. But another really popular idea is setting up a spousal trust for married couples. And you can make a gift now to a spousal trust, and you don't have to decide until you file your gift tax return after the end of the year whether or not you want to use your exemption on that gift and keep it out of both spouses' estates, or if there was a retroactive gift tax exemption drop, you could make a marital deduction election on the gift tax return, which would not need any exemption amount to be a tax-free transfer, because there's another provision in the tax code that allows an unlimited amount to go to spouses or special trust for spouses. So you could rely on that as well.
Well, it's good to hear you articulate your expertise in this area, Maureen. I'm sure a lot of our listeners have a hard time following all of that, but they know who to call if they want to pursue it. And those are all really good things. So the point of the marriage is you could set up a trust for your spouse and have the spouse keep the income, and then you can share on it, and that trust can be funded with assets that are out of your estate. But not everybody's married, and if you're not married and you want to try and get get assets out of your estate before the exemption is reduced, another idea is to use set up a trust for kids or whoever, and sell the asset to the trust and keep the note payments as a way to continue to get some income from the assets that you're removing from your estate. So bottom line is there's a lot of ways that you can approach this, where you can take advantage of the exemption and still not suffer any financial hardship as a result. But one other thing that I talked a little bit about a couple of podcasts ago, when I had your associate on the show, Peter Smiley, but it's so important, it's worth repeating, and that is, and this affects everybody regardless of how wealthy they are, and that is President Biden's proposal to eliminate the step up and step down at basis during life, and even more significantly, to tax unrealized capital gains even before an asset is sold. So why don't we talk a little bit about that? Would you mind pointing out the step up in basis?
So any tax legislation that would change gift and estate tax laws is expected to have a lot of income tax changes as well. And an elimination of the step up in basis and taxing capital gains would be a major economic change. And investors would no longer be incentivized to hold on to assets until death the way they are now, because right now, if you have appreciated assets, investors like to hold on to that until they die, if that's an option, because you can avoid that built-in capital gain tax. But if that's off the table, then strategies will have to be revisited, because it may make sense to recognize and pay that capital gain tax during life, because otherwise those dollars you're using to pay the capital gains tax, if you don't pay that during your life, those dollars are sitting in your estate when you die, and you could end up paying an estate tax on top of an income tax.
Yeah, just to step back a little bit, Maureen, I didn't mean to interrupt, but for those who aren't familiar with it, there's a rule right now in the Internal Revenue Code that says if you own an asset that's gone up in value during your lifetime, let's say you bought XYZ stock at $100, and when you die, it's worth $1,000. Your heirs' tax basis is $1,000, not $100. So if they sell it, it's stepped up to the market value at the date of death. So if they sell it, they now have no capital gains. Now it works the other way too. If it was worth $100 when you bought it, you paid $100 for it, but it's only worth $50 when you die, then they would get a step down in basis. So they would have their basis would only be 50. Right. And Biden's talking about eliminating that. And what we're talking about now, Maureen and I, is the fact that this would be a major change.
major, and there's a lot more revenue to be raised through changes in the income tax code than there are in even the gift and estate tax laws. So there are definitely going to be big changes coming to the income tax code as soon as, at least in my opinion, once that new tax legislation is, in play.
Well, I agree, Maureen, and I think that this change is much more likely, not going to say more likely, but much more tempting for Democrats to impose because it would be a huge revenue raiser. And, maybe the idea would be to do this and not change the estate tax as dramatically as we've been talking about. That would probably have some appeal for Republicans in the sense that the very wealthy, the very, very wealthy, are probably better off getting rid of the step up in basis than they are in the paying this higher estate tax because of the difference in rates. But the problem is with eliminating this step up in basis is, the impact it would have on the average and everybody, the non-wealthy. And so we'll see what happens there. The more scary part about this is that there's been some serious suggestions coming out of the Senate and the House that capital gains should be taxed even before the asset is sold. So if you own stock that's gone up from $50 to $60 a share during the year, at the end of the year, you would own capital gain tax on that $10 of appreciation. Now, this could be extremely onerous in a number of ways because, first of all, where do you get the money to pay the tax? You haven't sold it, so you haven't had a liquidity event. Second of all, what happens if the stock goes down in value during the year? Do you get some kind of tax break there? Do you get a deduction? And if you're going to do this, what about like a family business or hard to value assets? What happens if you own a piece of art and it goes up in value, or you got to pay tax on that, or what? You got to appraise all this stuff every year, or let's say you own a ranch out in Texas and that ranch appreciates in value. That means you're going to have to pay the tax on that. So there's a lot of concern with this, but the fact that it's even being seriously considered is a bad sign in my mind. So okay, well, Maureen, it's about time for us to wrap up. But is there anything you'd like to any closing comments you'd like to share with our audience?
I just want to mention that there's a tendency to procrastinate when it comes to estate planning and estate tax planning, especially when the exemption is as high as it is right at the moment, because it gives people perhaps a false sense of security. But things can change really quickly, and estate planning law firms can only do so much in a short period of time if legislation starts pending. So I really encourage anyone interested in this to start these discussions now. So definitely give that some thought.
Well, I wholeheartedly concur with that excellent piece of advice. And thank you very much for joining us today, Maureen. It was very nice having you on the podcast. I hope I can ask you back and that you can join us once again.
That sounds great. Thanks, Andy.
And thank you all for listening. We appreciate that very much. And please keep in mind that you should not act on anything you have heard in this podcast until you have discussed it with a qualified financial professional who's familiar with your personal situation and your investment objectives. And with that, I'll say thanks again and have a great day.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.